Hey everybody, how's it going? Lawrence here from financialthing.com, and it's a special edition of the live stream tonight. Normally we do, for anybody that hasn't been on the stream before, we do a recap of what's going on in the peer-to-peer lending news and what's going on in the industry. But I've been promising you now for probably a month or so that I'm going to bring on guests and we're going to start talking to the people that are running these businesses and the companies that you either are interested in investing in or that you're already invested in. And today, this evening, we have a very special, he's my guinea pig right now. He's the first Financial Thing stream guest, so be kind to him. But if you have questions, pop them in the chat. We're going to get to those questions, and we definitely want to get feedback. But we have Yann Murciano from the Blend Network. He is the CEO and the founder. And really glad to have you with us today. Let me just unmute you. Go ahead, say hello to the people out there.
Hi, good evening, everyone.
This is Yann. Just let us know too if you can hear everything okay, because this is the first time that, again, I've done anything like this. So if you have any audio issues or anything like that, just let us know that you can hear us okay. But Yann, as I said, is the CEO of Blend Network. I've been up to his offices a couple of times. I've always had a really enjoyable chat with him. He's extremely, extremely knowledgeable. And we're just going to kind of go through, Yann, your background, and get some information about Blend, and I'm going to pick your brain about the opinions of what's going on in the peer-to-peer lending industry, because a lot of our people that are watching right now, some of them have been burned by some of the companies that have really failed us, and I know you kind of had a passionate opinion about what's going on with that, so we'll ask you a couple of questions about that and just generally have an informal discussion. How's that sound, Yann?
Sounds very good.
Okay, again, thanks for joining me. So go ahead and just give me a quick overview of your background. Now, I know some of the people that have started up peer-to-peer lending companies don't really necessarily have a background in finance or in property, and you kind of have a special background. So tell everybody out there what your background is before you joined Blend.
Yeah, definitely. So, my background has been always in banking, in the banking industry. So really finance focused. I started my career trading foreign exchange in a bank in the US. That's why I have the accent.
It doesn't sound American. Definitely doesn't sound American.
Yeah, been 15 years now in the UK and still have my French accent.
Yes,
Never
you
can lose it. And so I moved 15 years ago in the UK. I moved for Morgan Stanley. I was trading there over 10 years. I was heading up a commodity trading team, so I was trading gold and copper, aluminium, so different commodity than property. And I left in 2016 to start our platform, Blend Network.
So you got this background in finance, and you said Blend was launched when? Was it in 2017 or 16?
We did a couple of deals in 17, but more like friends and family, more to test the platform, and really launch in January 18.
Oh, okay, cool. For anybody that's not familiar with what you do at Blend, personally, just a quick disclaimer, I'm not an investor through your company yet. I know you've been trying to get me on board for a little while. He's been saying, please come and review the platform, and I've been meaning to do it. I swear to God that I have. I just haven't gotten around to it, but you're definitely on the top of my list to come aboard. But let me tell everybody out there what Blend offers as a company for investors.
Oh yeah, so the culture, I'll say, the idea came a bit from my background, where I was always looking for good investments and looking for good risk rewards. And the idea is we set up the platform to lend to property developers in the UK. So I was really fascinated by the technology, what it can do by basically giving access to every investor to lending on some bigger deals. The choice you had was basically building a platform for consumer lending, for SME lending, or property lending. Consumer, I was not too much a fan because that's well, if there's a default, what are you going to recover from someone who can borrow from a credit card? Basically, the credit cards are quite expensive. You borrow at like 12, 18%, or even more sometimes. The only reason the borrower is going to come to your platform is basically because it's cheaper. So you're pricing the risk cheaper to attract the business. So I was not a fan of that as an investor, purely. Look at the SME business, which I think was very attractive. But an SME business in general is going to borrow around 6, 7, 8% max. If it borrows more, which is possible, but then the SME business is quite distressed because being able to finance an SME deals at a high rate, it means quite distress and a bit more risky. And if you have a default, same thing. What's the debenture value on a default scenario? So look at the property deals, and property deals because there's a lot of profit into development. People will pay, a higher rates like 8, 9, 10%, and you have a first charge on the property. So in theory, and I'm sure we'll discuss a bit later the details, if you do good due diligence, you can attract a good risk reward. But due diligence is the key thing.
So a lot of the people that, by the way, we have about 33 people live now. They'll see this video will be archived for other people to watch up on YouTube in the future. But we're getting a lot of people that are saying thank you for joining and thank you for coming on board. Now, a lot of the people in the chat are investors of, some of the mainstream peer-to-peer companies like the Funding Circle and the Rate Setters. They started in those waters, and now they're finding that things have considerably gotten more difficult. What would be a reason for them to jump on board with and I mean this with all due respect, Blend is probably a lesser known peer-to-peer lending platform versus, things like Rate Setter and Funding Circle. But why would they want to jump on board with a company like Blend versus going to one of those big name companies?
You're right. I mean, for sure, I would not compare ourselves to Funding Circle, which is a massive company listed on the stock exchange. But I think the idea, with our backgrounds, and if I tell you a bit more about the business, we all have, the company has a lot of experience into property and finance. We even have a former property developer who work with us, who does due diligence on the deals. And we are finance people who understand the risk really well. And I think those skills are very important. We're very focused on the product. We think really the key thing, and that's how we attract investors at a cheap cost, is because we build a good track record. Rather than spending a fortune on marketing, we build a good track record. And complaint we sometimes get, but it's a good problem in a way, is our loans getting funded quickly, even post-COVID-19, because we've managed our book really well so far. We've never had a £1 loss in the book. The returns are mostly between 8 and 10%. And we've built a very good track record. We really focus on the originations and the underwriting part, rather than trying to scale, the startup style where it's all about scaling and do not care about the product. One good example to give you an idea about the business, when we did our first equity round to raise money for the business, we did not go through a VC who was worried they would pressure us to scale very quickly. We went through some high net worth guys who could back us as well on the loans if we were short, if tomorrow we want to do a bigger loan and they want to back us. We have, to give you some names, we have the chairman of Oak North Banks, who's chairman of Citigroup Global Market as well, as the shareholders of Blend. We have a co-founder of Brevan Howard, which was the biggest macro hedge funds in Europe. They were managing $40 billion in I think 2012. And we have the family office of Maurice Levy, who was the CEO, is now the chairman of Publicis Group. It's like the third biggest media company in the world. So the culture, and those guys are all lenders. All our shareholders are lenders on the platform. And they really care about the deals, and I have personally as well invested in every loans we've put on the platform to demonstrate we have skin in the game. And obviously we like the product, so it makes sense. We all invest as well in those deals, and that's the key thing. Really, is really how we do our due diligence and how we build this track record.
Okay, so your loans are secured by the property deals that you are lending against. I noticed that one of the things you have is a very, very low default and expected default rate. I'm going to go ahead and put this up on the screen here so people can see it. But I can see only here that in 2018 you had one project in arrears. But other than that, for the last 3 years, from 2017 onwards, you've had zero defaults. And tell me about that loan in 2018. Was that something that just fell behind, and how was that handled, since that's the only loan that seems to have had issues?
Sure. So, I mean, to be completely transparent, we had 3 loans late due to Corona.
Mm-hmm.
One was already fully repaid. One was basically the work is completed and the property is tenanted, so he's probably going to repay in a couple of weeks now, but I wish he's going to be a bit more late because he's going to refinance at 3% and investors are getting 10%. So those ones are basically done, and the last one the one that is late over 90 days is one of the 2 loans we've done in the beginning, which was an SME loan. One has repaid and this one is still outstanding. This loan was at 14%, so the highest rate we've done literally on the platform. It was a great deal, still a great deal. I mean, investors have received to date 25% as interest because the interest has been serviced by the borrower. But with the coronavirus, he struggled to service the interest. Mm-hmm. So obviously, that's the most headache one, because all the development deals we've done are going really well. But as an SME, and we're glad we're not in the SME business in this Corona environment, things are a lot more difficult for SMEs and development. On the development deals, we hold the cash for the developers to complete. So when they were locked down for a month and a half, we did not give them the cash. When they come back on site, we have enough cash to complete it. Mm-hmm. So we're controlling a lot more the cash flow on the development deals. Yeah, that's, I mean, there's not much concern on this deal, but that shows you the track record we've built there. And this is one out, I forgot how many deals we've done, but it's probably 54, 55 loans we are now done. That's the only one really. Mm-hmm. So in a way, this cycle is in a way good for Blend, because showing that when you have a proper black swan lockdown that no one could have expected last year, mm-hmm. We still manage our book really well and still manage to deliver a very good track record in probably the most difficult environment.
Yeah, absolutely. So one of the things that sort of held me back from investing through Blend has always been that you have a pretty high minimum of £1,000 per deal. Have you had any thoughts about, I know you said you have probably too much money on the platform and the deals are getting filled pretty quickly. And I know some of the people in the stream are asking about, has there been any thoughts to maybe reducing that a little bit down to a smaller level so people could test out the platform and get properly diversified? Or is that something you're going to keep as the way it is?
We every at least 6 months on the board meetings, we review that, to be honest. Mm-hmm. The challenge you have is, let's face it, the more you're going to reduce it, the more clients you're going to have putting a smaller amount. Mm-hmm. And it costs you more to do the acquisition of clients and managing the platform. And as you can see, a lot of platforms out there are not profitable. And for us, the minimum of £1,000 allow us to get into profitability quicker. So it's a business decision. I'm completely transparent with you. Mm-hmm. Should we review it in the future? Yes, for sure. We'll have a think about it. But today, I don't think it's something we're going to reduce in the next 3 or 6 months. And I understand people want, obviously, to invest less and have more diversification. It makes sense. But for now, we're probably going to keep it to £1,000. So in reality, if you want to invest in Blend, you need at least £5,000 to £10,000 to diversify properly, because you don't want to invest in one or two deals. If you're investing on other platform, then it's fine, because one deal on Blend is technically a diversification of your other investments, other lending. But if
Sure.
you invest only on Blend, you definitely need at least 5 to 10 deals, I would say.
Yeah, to be properly
Way more.
diversified. I'm just putting a couple of comments up on the screen. You probably can't see that because you're on
Sure.
Skype. But Stephen Hale says, "Cheers, Yann. Good to see you. You're helping me decide whether to invest or not." And he said he doesn't mind investing a minimum of 500, but £1,000 is slightly off-putting to him. So just a little bit of feedback. And Steve Manton says, "Hey Yann, any chance you can reduce the min investment in your loans down to 100?" So you're getting you're getting offers here.
It's a common topic. No, but
Yeah.
we know that. But I mean, to us, the idea is the loans who are, a few £100,000 are already reduced to £1,000, and it's all about the challenge. The worst is, to go into a business where I mean, at the end of the day, it's still a business where I think we have to go in profitability and to see. I mean, I'm sure we're going to talk about those platforms who went bust, but the worst is not to have the profitability at any point and then go bust, and then it becomes a massive headache for the investor. So that's our focus as well. And as we grow, maybe we'll be able to. But and I definitely heard the feedback. Clearly, it's a topic.
You probably hear that a lot. So
yeah, that's true.
But hey, everybody out there, if you can go ahead and hit that thumbs up button, it helps with the YouTube algorithm search while this is going on for people to be able to find this interview and this Q&A session. So hit that thumbs up, hit the subscribe button. Alan Toombs here says, Yann, that he is already investing with you, but as Steven said, 1,000 is a bit off-putting, 500 will be a little bit more enticing. But there you go, he's already invested with you, so that's one of your...
At least they want to invest, which is a good thing.
That is a good thing. It seems like everybody wants to come on board. So, and that was one of the questions that somebody has asked is, how big is your loan book currently? And that was the next question that I was going to ask you myself. So that's from Dave Dawson. He said, how big is the loan book for Blend, and does Blend make a good profit? Are you solvent? This is the important thing right now.
Solvent, yes, for sure. So we've done just under 20 million pounds of loans. We'll be at 20 million probably next month. We got about 40, a bit more than 40% as repaid. So that gives you the loan book size. About solvency, which we are, literally even during the lockdown was a bit of an opportunity for us, because a lot of competitors who were struggling with the cash flow had to put their staff on furlough. Mm-hmm. Whereas we kept everyone, no one went on furlough. We basically tried to make a lot of noise to all the borrowers and introduce her out there to tell them what's change business. We want to do business. And during lockdown, we obviously have not issued any loans in April, because if people cannot go on site, what's the point of giving them money? But we work on a lot of projects and a lot of deals. And as soon as Boris Johnson spoke and said, if you work on the site, go to work, we were already there, and we listed some loans straight after. And actually, we had a record month in June this year.
Yeah. You seem to... I always see new loans coming across my emails from you, which is a positive thing to see. So 2019 and 20 has obviously been a really tough year for the peer-to-peer industry. I think we've seen a numerous amount of companies go under, and I want to say that when I first met you, I don't remember exactly when that was, it's probably about 2 or 3 years ago, that you had mentioned some potential issues at the time that you thought were going to happen in the peer-to-peer industry. It was almost like you looked into my crystal ball here and knew exactly what was going on. What's your outlook for the peer-to-peer industry in general? And do you think there's going to be this continued contraction of where we're going to see less companies operating, but the strong survive and the weak ones are just sort of forced to stop?
Yeah, I mean, first, the platform closed. There was different reasons, right? If some of them was probably for negligence of not doing great deals and a lot of defaults, and then the rising defaults take the investors out. So then the platform has to shut down and become insolvent. Or you have some stories which won't comment much because I don't know the details, but talking about fraud, which is a big issue, and has made a bad reputation for the sector in general, which is very annoying. But I hope a lot of the market has been cleaned. I don't know really what's going on. And it's very difficult to know what's going on behind the scene. All those platforms, you go on the website, you say, oh, they have a nice website, the FCA regulated, you would think everything is fine, but that's not always the case. So I think they're probably in the future, what I expect basically is probably the FCA now to be a lot tougher auditing those companies, and may find out if someone doesn't act in a professional way, they might be forced to shut down. And I think we're seeing it already on the mini bonds platforms. A lot of platforms had to shut down because the FCA wasn't. I mean, I don't know as well exactly why they closed this platform due to because of the FCA. What was the reason behind? But I think at some point the FCA is going to come and look at the peer-to-peer market. I don't think they'll make it illegal like the marketing the mini bonds, but they might review how the platforms are behaving. I mean, there's a lot of regulation actually that's in place. Platforms are directly authorized already and fully regulated, but clearly there are some rules by the FCA that are not applied on every platform you see out there.
Yeah. One of those is I was under the impression that everybody had to show what their spreads were now, and I've noticed some of the platforms are still not showing what their spreads
not many
are.
Not many people are showing. You're talking about transparency on the fees, right?
Yep.
Not many platforms are showing it. You're right. But so you have two risks. You have one risk from a regulatory point of view, and you have one risk on the product. And that's one thing that is sometimes frustrating on the platform is, everybody asks us what's the loan to value. Problem is, I show a product at 60% loan to value. You can't compare the 65% loan to value to another product at 65% loan to value, because there's a lot of things you got to look at. First, I think it's a strategy. I mean, I told you in the past, Lawrence, but we're very focused on residential properties, anywhere in the UK. But when we say anywhere in the UK, if we go in the regions, we're not going to fund a house for £200 million. We're going to fund flats for £150,000, and that's what we think it's liquid. So you can be at 65% loan to value if you've done a great due diligence and the developer deliver, becomes very liquid. If you haven't done a great due diligence and you've given forward funding and the development goes into default, it's a lot more tricky to recover full amount of your money. But now some platforms say, we've done a 50% loan to value on the land without planning. Well, it's a great low loan to value, but it's very liquid. If you're going to do it on this £2 million in the house, as mentioned, in the middle of nowhere, a 5,000 square foot house in the middle of nowhere, who's going to buy it? And most of the house trade at £500,000 or less. There's no buyer for it.
Yeah. That's definitely something that I've sort of tried to educate people on, is be careful what loans that you're picking out, because if you buy a farmhouse in the middle of Scotland, there's just not going to be that many people that want to buy something like that.
I would say, yeah. You're right, but that's what I would say. My recommendation, if I had to give one, would be the biggest due diligence you have to do, obviously on the deal you can, and you got to see if the platform is transparent about the information they share on the deals. But first is a due diligence on the platform. Who's behind the platform? Are they, what's their background? Are they trustworthy people? One, do they have the experience in the product they are putting on their listing on their platform? Because if you invest with a good platform who does a strong due diligence on every deal, then most of the deals, some deals might fit your appetite of risk, some might not, it's possible, but the quality of the deals on this platform should be good. If you look at a platform who they don't check properly, their due diligence is not super thorough, then you might have a low loan to value deal, but high risk of default and high risk of not recovering your money because of the strategy is wrong as well.
Now, so talking about doing that due diligence, how is your average investor going to know whether the guys behind a certain platform are experienced or good at doing their job. Because from the outside, they don't get the kind of information that I get. I try to provide people with as much as I can. But how's your average person going to know whether the people are trustworthy or running these platforms?
You're right, and that's a fair question. I think two things. First, I would check, and that's a very good thing from the FCA. Now, most platforms, not all of them yet, but most platforms have a statistics, which is a track record of the platform. That's one thing.
Mm-hmm.
And make sure you read the small line and everything, because I've seen platforms who have statistics, but their default definition, or one side they talk about loans, the other side they talk about projects. You see what I mean? Like they're not completely clear about what you're looking at in the statistics. But if you do a good homework on the statistics, that will give you an idea of the track record of this platform. And second thing, I'll say, who's the team? I really think in the job we do, you need to have experience in property and finance. I mean, finance only, I don't think is enough, and I come from the finance industry. Property only, I don't think is enough. I think it's a mix of both, because property guys will be able to do a very good due diligence on, the planning, the right of access, a lot of details related to the project. And then finance people usually understand really well risk, and as well, like for example, like when we had the COVID, we didn't wait 3 months to change our credit policy. When we saw the stock market coming off in March, and end of March, when equity were really coming off, we smelled something that wasn't good, and we immediately reduced our loan to value to mitigate the macroeconomic risk, basically.
Right.
And and that's the key thing, is anticipating. Don't wait for things to default to say, oh, now we change our credit policy. It's always anticipate. If there's a market that looks good, you go for it. You don't have to wait for everyone to do it. And when the market starts smelling bad, you just go away from it. So you can see on our platform, we've never done really prime London products, because when we started, it was really just after Brexit vote and stamp duty. And at that time, the market was a lot more competitive in prime London, because everyone who had money wanted to invest in London. So the interest rate was lower in London, in central London, and to us the risk was higher. And this has been proven to be right. At the opposite, we're going quite far away at the time. We're landing in Northern Ireland, but the rate was higher, and everything we've done over there sold at the time basically off plan. So the strategy is the key thing. It's not about doing the deals and doing the due diligence. It's have a strategy and then find the deals that fit the strategy.
Right. Yeah, that's really good advice. So Dave Dawson has said that we rely on a lot of peer-to-peer lending sites to do good due diligence, but I think a lot of them have failed the investors on that side of things. One of the things I was going to ask you, with the Lendy and the Funding Secure Administration, we've seen a ton of their recoveries coming back with, valuations being completely inaccurate. A loan was given for £1.5 million and they're recovering $500,000. So how do you make sure that the RICS valuations are actually accurate when you're lending money to these property projects?
Right. So I'll say a couple of things first. I'm going to go back when I think, without mentioning those names or any names, make sure again the team is good, because it's all about the due diligence. And one thing you were asking before, how do you know? I mean, do your due diligence. Who's the team? Look at their LinkedIn profile. You will see what they've done before. What's their background? Now going into the RICS valuation, are they completely wrong? Everyone says they're completely wrong. My view on this is RICS valuation works in theory, if that makes sense. So what they'll do is they do their comparables. They say, well, the price per square foot in this area is X per square foot. Your house is 5,000 square foot, so your house will be 5,000 times the price per square foot. But in this area, if houses trade, like the detached house trade, most of the houses are like 1,500 square foot. That's where there's demand. no one's going to buy the 5,000 square foot. So even the theoretical value of this risk value is right. The strategy is completely wrong. So there will be no demand for half the price of this house. And that's why that's the key thing is if you have, they'll give you a theoretical price, but that doesn't always work. So what's the liquidity for this asset? And if it's not liquid, then the next bid is miles away. But if you have a flat that is easy to rent and deliver a 5% yield when you rent it out, then in default you're going to have a lot of buyers, because if you give it a 20% discount and you offer a 6% yield to an investor who's going to buy this flat and rent it out, you're going to have loads of buyers.
Yeah.
You see what I mean? So that's one key thing we look at. Now, another thing about the risk valuation, we don't just lend on the loan to value to the valuer. We do our own comparables, our own valuation in-house. For us, it's important to have a risk valuer to show we have an independent report for our investors. But sometimes the risk valuation is going to be too high, and then we're going to call him and challenge him. And if it's too high and he doesn't want to change it, then we're going to say fine, but we're going to restrict our let's say the risk value say worth $1 million and we think it worth £800,000. Then we're going to go to our borrower and we're going to tell him we'll lend you on the basis of £800,000. And that's how it is. Sometimes it's the opposite. We have frustration from the borrower because we look at it and we think worth $1 million, and the valuation guy say worth £900,000. Doesn't happen often, but it did happen. And then we have to take the most conservative value of the two. So the borrower will have to reduce the value, and obviously they don't like it, but we have to protect our investors.
Right.
So the risk valuation is, you should have it, you must have it, so it's independent. But it's definitely not good enough. It determines your maybe loan to value, but if you're on the wrong product, then your loan to value is irrelevant. And that's one thing I learned in trading is, don't look always at the upside. If you get 8, 9, or 10%, to me it's almost the same. Look at your downside. What's the worst case scenario?
Right.
That's why we look at the business. We stress test the cash flow. What happens if we don't get any business for 3 months, for 6 months? What happens if, you always have to look at stress test your scenarios and make sure the downside is good. So when the valuers say, the tenanted valuation is £500,000, but the vacant valuation is 400. Well, if I'm in default, because the borrower has not finished the project, we're not going to get to the tenanted valuation. It's going to be less.
Right.
So, what's the point of looking at this valuation? You're never going to be able to, you're going to sell it when the project is finished because he hasn't managed to get it tenanted. If he got it tenanted once the project is finished, then the bank is going to be happy to lend every day.
Yeah, that makes a lot of sense.
So look at your downside rather than just the upside. And that's one thing dangerous with peer-to-peer, I have to say. A lot of people I've seen on platform, they're always attracted by the highest interest rate. And interest rates often, obviously, should, if the platform is doing the right job, reflect the risk. But be careful of going too high. You don't want to be on the second charge. If you want to go on the second charge, make sure you understand you're on the second charge, basically. Everyone has different risk appetite. What we're trying to do at Blend is really looking for good risk reward. And that's what I've learned as an investor with my background, is look at good risk reward. So if you take, you lend to a deal and you think it has to be good value, but you cannot lend to someone at 10 and the risk worth 2. You see what I mean? That's impossible.
No, I understand. Yeah.
But it's good. For example, what you're talking about, the fees transparency, it's very good. Because if you lend a second charge platform, which is charging 24%, and they give 10 to the investors, now you can see it.
You can see the real risk involved there.
The real risk involved, exactly. The all-in price determines really pretty much the risk, because then the market is competitive out there.
Yeah, absolutely. And we're going to talk a little bit about second charge loans in a second, because I've had actually a couple of emails about that this week, people not understanding the different levels of risk in that. But I'm going to put you on the spot for a second. Mike Powell, one of our watchers right now, has said that He's not a fan of the 1K minimum, but he can't pass the KYC anyways, as Blend insists on copies of documents, unlike many platforms who do it electronically. Is that true? Do you have to actually send in the paper documents?
So no, well, we usually we always ask for KYC, a copy of your, a picture of your photo ID or driving license or passport.
Mm-hmm.
And if you haven't been in your property for more, I forgot, it's not me doing the onboarding, but I think it's like 5 years or 3 years. We need a picture of your proof of address.
Okay.
Which is fine. Are we tougher than other platform? I don't know, but that probably reflects how we are. Yet we're very conservative. Like if we cannot demonstrate KYC and email perfectly, we will ask a proof of address or the document is relevant. I mean, it can be annoying, I understand, because you always want to make it easy to register in a second, but that demonstrates that we're careful, I'll say.
Can those be submitted? Can those be submitted electronically? I'm pretty sure I remember doing mine electronically.
Yeah,
right?
No, of course. No,
Okay.
definitely. I mean, you can. The passport is on the registration. The proof of address you can send us by email, or we can send you a link to upload it somewhere. Probably basically more secure if people want. So no, definitely.
Okay. And
I mean, we're never gonna ask you to send us a document through the post. Basically, we don't want that.
Okay. Somebody, Dave Dawson, one of our watchers, has said, "Do you accept certified copies of passport?"
We accept, but there's no need. You don't need to get it certified. Just give us take a screenshot with your telephone of your passport and upload it on the platform, and that's good enough.
Got it. Okay, no problem. Just wanted to clear that up.
Okay. Thanks.
So yeah, just to, I don't want to spend a lot of time on this, but there are some of our watchers who are not as experienced as others, and I've talked about these second charge loans. My risk appetite for second charge is pretty zilch, because a lot of the platforms just don't pay anywhere near the type of interest that I would expect to get on being a second charge holder. What's your view on second charges? Do you offer second charge loans through Blend or not?
We don't offer a second charge to the lenders. They should be obviously much higher rate because they're much higher risk. Nothing wrong with it. I mean, a lot of institutional, very sophisticated investors do second charge, but it doesn't fit our appetite. As I said before, I lend on every loan we've put on the platform, and I don't want to lend on a second charge. So if I feel like I don't like it, I don't want to give it to the investors. To explain briefly, I'm sure, probably all you guys understand what's a second charge, but if they don't, basically a second charge, you lend behind the senior charge, which is a bank or a platform like Blend. If on a £1 million property, for example, we lend £650,000 and the second charge lends £100,000 behind us, he'll be behind us after capital and interest. In a default scenario, let's say we sell it at £650,000, we get our capital back and no interest, for example. Well, the second charge, which was secured by the second charge, actually lost 100% of their money. So theoretically, having a first charge, your property cannot go to zero value, or as you've done something very, very wrong. But second charge, it could easily go to zero. So obviously, you get rewarded for that, and you get a higher interest rate for taking that extra risk. But it's up to people what they're looking to do.
Right. Okay, that makes a lot of sense. And we'll go through everybody's questions at the end and kind of answer them quickly, because there are a few people that have some questions about investing through Blend and general peer-to-peer questions. So one of the things that's happened, we've seen the liquidity sort of dry up within peer-to-peer due to what's happened with the economic conditions of COVID. What's the liquidity like on Blend? I know you offer a secondary market. Has it been moving? What's the situation with the secondary market?
Yeah, secondary market. We've seen a little bit more activity during lockdown. So I'm talking April, May. Was a bit slower, but traded. And then since June, it would trade back to normal. we don't have much sellers. If you come to our second market, you don't see much, you barely see anything because there's not many sellers. People who tend to buy the loans hold them till maturity, and everyone who's been selling has been really selling it. Everyone has been basically everything traded and very quickly. So you never see something staying on the platform. We got actually an award for that thing. I think it was like best secondary market in peer-to-peer we received. But yeah, liquidity is good. I mean, liquidity in March, end of March, in April, has probably gone down, but we didn't list anything, as I said before, because we didn't want to in the environment. But then in May, it started coming back, and June was our record month, and definitely in June and now we have more cash than we had pre-lockdown. And I think demonstrating during a lockdown that we have built a very good track record has probably given more confidence to people, and there's probably less opportunity to invest your money now than I mean, I was saying, like, as an example, the equity market.
Yeah.
It's quite surprisingly super high compared to what's happening in the world, but it's difficult if you are not invested in the equity market to go and buy and go all in the equity markets right now, right? I mean, it keeps going up, so it's crazy except today, but
yeah. Yeah, both Gary Thomas and Stephen Hale said they've never seen anything available on the blend secondary markets.
Yeah, and that's right. I mean, they've been traded. I mean, we can easily demonstrate they've been traded, but in a way, it demonstrated that everyone who needed their liquidity managed to buy it. Otherwise, things will be sitting there all the time.
Okay, that makes sense. Let's talk about your views on the UK housing market. Where do you think it's going? Because obviously your business is highly based around the development of residential property. What do you think is going to happen in the next year?
If you have asked me that, and actually people asked me that in April, I thought the market was going to come off 7 to 10% between June and year end. Surprisingly, hasn't come off at all. Probably because with the help of the government on the stamp duty. I think we had so far the right strategy by doing the more affordable side of the market rather than the luxury thing. If you look at central London, properties now are struggling. But there's a lack of supply. There's a housing crisis in the UK. There's definitely a lack of supply in the housing market, across the UK. The government, I think, is going to try to help people to buy it, to buy properties, to support the economy because they want to build. So for now, since reopening, really, the property market has been very good. Surprisingly, to be honest, it's been much better than what we thought. There's still a risk. I'm going to be honest. There's still a risk because people are still getting their salary. They're on furlough. Unemployment could get worse. I still think because there's a lack of supply, and that's back to my commodities trading, you always have to look at supply demand. There's a lack of supply in the regions for houses that are, 300, 400,000 pounds per house, 150, 200 pounds per flat. So I think those houses are going to be well supported. There's still the Help to Buy scheme in place. Those are still the good markets, but because there's more macroeconomic risk than they were last year, pre-COVID at least, we've reduced our loan to value. That's the key thing. So for us, if the market is down 10%, and that's how we look at it. So if the market is up, great. People have done a great deal of their land at same rate as last year, but on a lower loan to value. If the market is down 10%, that's been absorbed by this loan to value. Do I think the market is going to come off 30%, like a big crash? I don't think so, because I talk to a lot of high net worth and family offices, and this crisis is very different from 2008. In 2008, when you woke up after the market has crashed, a lot of people lost a fortune across property, equity market. People lost everything. In this environment, I don't know people who went bankrupt. Not many people lost everything. I mean, you can find cases, I'm sure, but most of the people, the mass, hasn't lost everything, or some people have lost a little bit, some people made a little bit, but it hasn't been a disaster. And people with a lot of money, investors, they have cash. They're sitting on cash. So if you tell me now property market comes off 15, 20%, I know a lot of people will be keen to buy on the buy to let to get a decent yield on their money, because when you have cash at the bank, it's sitting there and you make nothing on it. Okay, peer-to-peer is attractive, but sometimes people have more cash. They don't want to put everything in peer-to-peer. Buying property, if you can yield more, they'll be buying property. So I don't see it coming off more than 10%, but the risk is there of 10%. That's what till the risk is out, we're going to stay at a reduced loan to value.
Yeah. And generally, so as far as blend goes, do you think that the rates that you're offering investors are going to change at all? Do you think you'll be reducing them, or are they going to remain constant?
I thought, I mean, from when I started to pre-corona, I thought, well, the rate is too high. I'll be honest with you, I think, because the banks, the Barclays and HSBC and all those high street lenders are not lending to those developers. So the rate is very attractive. That's why I think it's a good risk reward, even if capital is at risk, I should say.
Yeah.
But the rate is very attractive. I thought with more platform and more alternative lenders in general coming to the market, it will compress the rate, which happened a little bit. If people have been investing on development finance in 2015 and 2019, the rates has come off a little bit. I mean, you could lend what you're lending now, 9, you could lend at probably 11, 12, 3 years, 4 years before. But now with the crisis from COVID, some of this liquidity is gone and the rates are going up again. I would say at blend, we could have done the same type of loan to value as pre-corona at a higher rate. But we took the decision not to increase the rate, but to reduce the loan to value. And that was our strategy.
Okay.
So technically, it's more expensive for the borrower, right? Because they have to put more equity into the deals. We could have said you put the same amount of equity, but you pay more. But we tell them no, we're happy to. We keep the same rates, but you got to put more equity into every deals.
Okay, that makes sense. You mentioned, Yann, that you there's skin in the game on blend within the loans, right? That you invest money, or is it the company or is it you personally?
Company, I don't think we're allowed. It's me personally. It's not a commitment that we have legally on the platform, and we don't really market it like you would see nowhere on the platform because. Hopefully we grow so big I can't afford to be on every deals anymore at some point.
Yeah.
But to date, like I've invested in every deals we put on the platform, and yeah.
So you've got a lot of faith in those deals. Okay, Yann. So I've got to put you. Oh, and just again, if you have questions for Yann, we're going to run through them at the end when I'm done grilling him. We'll just kind of go through the Q&A real quick and answer some of these questions that you have. So hang out in there. But I'm going to put you on the spot, Yann, because.
Sure.
I was a foolish investor in Lendy from the very beginning when I was blinded by the peer-to-peer stuff that they were doing, and we've obviously had a couple of failures ever since then. We're not going to pick out names, but what I want to ask is, what is the FCA going to do to hold these people accountable for when there's questions of fraud involved? It doesn't seem like there's any real. Anything that the FCA is going to do to stop these people creating these companies and then defrauding investors. There's very little accountability. What can the FCA do to make this better for people so they have a little bit more trust when they're investing in companies that they don't really know much about?
Yeah, as we said before, there's two types of default from the platform. One is negligence, where they haven't done a good due diligence and people are losing money and it's terrible. I don't know what the FCA can do because legally, if they didn't have the skills to do it, it's not illegal for them, I guess, to have default. So I'm not sure what the FCA can do on that. How do you demonstrate?
The FCA is kind of authorizing these companies to operate, and that's a huge problem.
They authorize hedge funds to be
Neil
trade and someone bust. Yeah,
Yeah.
exactly. But there's two things. So one is default and one is fraud. Fraud is a different level. I can't even comment on it, but I hope when there's fraud, something will happen and something bad. I mean, stealing money is not the same as negligence. Um, so that's two different things, and I think fraud will definitely escalate a lot further. It can take time, and I think people have to be patient. And doesn't mean they're gonna recover their money because if there's money left, then great. But if there's no money left, you can get in big trouble. But it doesn't mean you're gonna get your money back. And default, I think default the FCA is doing actually a lot of things at the moment. Things that came out in December and more transparency and everything. The FCA is doing everything they can to make the sector a lot more professional. I think, and that's a good thing. And I
Okay.
think platform who are regulated now compared to platform got regulated a few years ago are probably not going through the same level of details. I think now there's a lot more question because by experience you can see those platforms were on defaults. Why did they go on default? They had the right governance. I mean, how do you know before transparency on the rate if a platform charge 18% and pass you 10? How do you know you're lending at the right risk? You think you're getting 10, then that's the risk. You're getting 6, then it's low risky. There's one thing actually that I would not be surprised if the FCA change, and some of them are great platform by the way, but it's a lack of transparency. You know, those platform where you don't invest on the project, you invest at 5%, but you don't really know what's behind. So I've seen some platform where you go and you lend your money at 5%. You deposit almost it sounds like you deposit your money at 5%. The thing is, it could be some investor might not understand there's development risk behind or SME risk behind. They think they're just putting their money and getting very similar to the mini bonds, basically. A bond sounds safer than what it is, there could be decent risk behind. And I think the FCA is gonna get tougher and tougher, but that's almost normal life, it's always like that. In the beginning there's some mistakes done, and then the FCA regulators learn, and then becomes tougher and tougher and tougher, and that's what's going to happen, I think.
Yeah, I agree.
It's the problem, but even investor will invest on this platform. It was very difficult to say for anyone to say that was fraud, right?
Yeah,
Very
yeah,
difficult.
yeah, I agree. One of the things that I've always sort of put forward is this level of interest rate that lenders are being paid versus what this risk amount is that they're taking. Sometimes you could take a loan that's 6% from one platform and a loan that's 6% on another platform, and the risk levels are completely different. One of the things I know about you guys at Blend is you pay quite a high interest. Your average is about 10.25%, 10.25% has been your average per year that you
It's
pay.
reduced, to be honest. Probably this is since inception, but we used to do quite a lot in Northern Ireland where we could charge 12% for the investors. Now we are more between 8 and 10. So if you invest
8
in the
and
next
10.
12 months, expect to get circa 9%.
Okay, so Dave Dawson has asked, and I don't know if you want to answer this or not. You can always decline, but he said, what rates do you charge borrowers, and is that shown in a transparent way on the website?
Yeah, so you can see once you fully register, you have access to full information, and you have the information pack and the executive summary on the website, and on the financial tab, you can see the spread. So usually what we do is we price the risk for the investors. So we say this deal is 8% or 9% or 10%. Then we charge a spread, we charge a fee to the developer for doing the due diligence, which is standard market as everyone, it's quite competitive, so everyone's pretty much the same. And then on the interest rate, because that's the question, we usually charge 2% on top for a servicing fee, so for doing the monitoring and servicing the loan. There are cases where we've done 1% because the borrower was competitive and we wanted to reduce our fee to win the business and be able to offer it on our platform. There's some case where we charge 3% because the loan was small and far away, and complex, a lot more work for us. So the 1, 2, or 3%, which is usually 2, in pounds, it's not the same if you do a £200,000 loan or a £2 million loan.
Mm-hmm.
So if we do £150,000 loan and there's a lot of complexity in the deal, we might charge a bit more. But our standard and most of our loans is 2%.
Oh, okay, so it's transparent. Once you have an account, you can go in and see all of that information. Okay, great. So Dave has also asked, what's your system for if you did have to take over an asset in recovery? Well, and obviously you don't have to go through the entire process, but you haven't actually had to do that yet, correct? Because you haven't gotten to that point.
Yeah, we haven't executed any default basically to date. The SMU one hopefully will be all right, but we're trying to get refinanced. But that could be the only one, the one that's late.
Mm-hmm. So you're doing such a good job with the due diligence that you don't even need to.
That's the key thing, to be honest. You spend a bit more time on due diligence, and it saves you a lot of money at the end, making all those work, even for us, the business. And that's why we don't want to take more risky deals, because more risky deals might still deliver you, instead of 9%, 14%, but then after default you might get 10 and still be very good, but a lot more work for us and less good for the business. So what we've done, we've actually established relationship with receiver and administrator, just in case we have deals going bad. We've asked them to review all our legal documents. So we've stress tested our legal documents to say, okay, this deal is going bust, what happened?
Mm-hmm.
And they've reviewed our document to make sure the legal documents are good, and they were very happy with the documents. So we established a relationship. We obviously will appoint a receiver and sell it. The ideal scenario is not for us to step in and complete a project. We have the experiences in-house. We have, as I said, a developer in-house who's done decent projects in the past, but we have full process. It really depends. If you have a project that is 100% completed, it's not going to be the same process as a project that is defaulted in the middle, at the end, or in the beginning. I've lost you.
David has also asked, some of the problems that a couple of the platforms are experiencing right now is there's just too much money being lent. So when people are trying to manually get into these loans through manual lending, they're just not getting their allocations. Dave Dawson says, is the only real way of lending via Blend auto lend, or would you be able to get a good part of the loan using the manual function? And how do you handle that balance of making sure that investors are able to get their allocations of loans?
And it's true. I mean, it's true. He's right. And the good platform usually get the funding too quickly. It's true. I still think, and it's a challenge we have, but I still think I prefer to have some. If I have to decide, you can't keep your balance perfectly right every day. Do we prefer to have good quality deals and people missing it, or accepting more deals, lower quality, and filling every investor? I mean, to me, I don't even think 2 seconds about it. Obviously, we prefer to have the balance where some people are going to miss it. So today on Blend, you have auto lend, which takes most of all of our small loans. And then when we have bigger loans, then they are available for manual lenders. So I'll say loans usually up to £300,000, they get fully funded by auto lend. Above that, it's acceptable for manual lenders. So you don't have to go on auto lend. It's true that if you're on auto lend, you get access a bit more diversification. But it's a challenge to treat customer fairly. And I think, again, it's an FCA constraint that we're trying to take very seriously. It's we took a simple rule that is first come, first serve. So if you're gonna say I'm gonna lend £1,000 on the next loan through auto lend before, or 5,000 across the next 5 loans, you will be served before the person who look at the loan, 2 days after it's on the platform. And that's what happened when you build a good track record. You get more and more investors registering on the platform, people talking about it, and people who wants to lend. But it's a
difficult one.
It is a difficult one, and we're growing the team, and we want to build up the origination, bring more deals on the platform. The solution is to bring more deals on the platform.
Mm-hmm.
So we build up the amount of loans we put on the platform, and then it will keep basically more people able to invest in our deals. But we cannot do that overnight. It takes time to do it correctly, do it the right way. If you don't want to do the right thing, it takes a bit of time.
Yeah.
If you do it too quickly, and we've seen it, you see what happens. So
yeah.
we get pressure from the investors, like I missed it. But if we have 20 million pounds of loans to bring on the platform, and we have 30 million available, some people are going to miss it. We're not going to say, okay, now we're going to accept 30 million and lower our criteria just because we have the cash. I think that would be the wrong thing to do. So it is a problem, but you prefer to have that issue, say I missed that loan and invested on that one, than say I've invested in all of them and I got default on 20% of the book. You know what I mean?
Yeah.
So
let's not do that.
It's a change. No, exactly. But it's a change. You got to keep the balance, and the balance, in my view, has to be a bit more that side. Some people missing the deals rather than accepting too many deals.
Okay. And David also has asked, is there much new in the pipeline coming through as far as new loans?
Yeah, we got currently 9 loans under due diligence. So
wow. You're busy.
Really, we're we're actually looking to hire because we're too busy now.
Okay.
So we're in the process of hiring people to help out.
So lots of new loans coming down the pipeline.
Yeah, we have quite a lot. I think there's one good thing as well in the market. Post-corona, we've seen some competitors, not peer-to-peer, that were offering similar product to us, who they had 1 or 2 lines of funding from institutions, and the institutions have pulled out during the crisis.
Mm-hmm.
Even now, if they want to come back, those guys could not afford to do 6 months without any business, you can't afford to run a business if you don't have any income for 6-9 months. So they've pulled out the market, and we've seen a lot of basically introducers and developers coming to us saying, oh, I was going to do this project with my usual lenders, now I'm looking for someone else. So we're seeing more and more requests. So we're hiring now.
Okay. That's a good thing.
Yep.
John says, Yann, who do you see as your major competitors within the peer-to-peer market right now?
I hate mentioning the competitors.
Give me one.
I don't know. I think it's not really peer-to-peer anymore, but I'll say Lend Invest is definitely one we see when we quote stuff.
Okay.
Assets, once in a while we see them as well. RateSetter was one, but I don't know what's happening with their property book because they sold the business, but they didn't sell the property business to Metro Bank.
Right. What's going on is the peer-to-peer lenders will continue to fund secured loans.
So you can still invest on RateSetter on new property loans?
Yep.
Okay. So
Metro is only doing unsecured lending.
No, I know, but that's why I don't think they're gonna keep peer-to-peer. I don't know.
I think they'll get rid of it eventually. I think the RateSetter
I'll be surprised they keep it. I'm sure something will be announced soon. But we definitely saw them on development finance as well.
Okay. An ES in Portugal asked, does Blend accept investors from outside the UK?
Yeah, we can, as long as we can do KYC and AML checks. We can accept pretty much, you're not gonna like that, pretty much anywhere except USA. US for tax reason is very difficult, almost impossible. So we haven't accepted US. Canada as well is a bit difficult, but a lot of countries are. Portugal is not a problem. We have investors from Portugal already.
Okay.
I guess he's from Portugal with a name.
Yeah, I think she may be an expat living out in Portugal. So.
Right.
John Morgan has asked, how long does it normally take to sell a loan on the secondary market on Blend?
So what we've seen recently, it's been usually within 24 hours, really. You can only sell at one point about secondary market. I've seen some platform who talks about now introducing premium and discount on the secondary market, which I think is a great thing. Because if you sell it at discount, obviously you're going to sell it you could sell it before on Blend in a second on a discount, and if you put a premium, there's no many buyers. But now the FCA wants to sell it at par value only because it's a fair price. So we only can we've changed our secondary market from par discount and premiums to par only.
Okay.
Which I think is annoying because it's a great tool for the investors to be able to sell premium on discount.
Yeah, absolutely. And Dave has asked, and I've asked you this before. He said, with a £20 million loan book is not huge. Is it easy to make a profit and pay your bills when the loan book is 20 mil?
No, I mean, we're not profitable yet. Let's be honest. We've done an equity round, as I said at the beginning of the call, so we have cash to fund the business. We could go in profitability in 12 months, but the discussion now, quite confidential, I don't know if we could say, but I mean, it's in discussion.
Mm-hmm.
The idea is more like, do we want to keep investing or do we want to go to profitability? And we don't want to be like crazy type Uber style to scale and never see profitability for years. We don't want that. I mean, that's not the model we're looking for, but we might be looking to invest either till the end of next year or potentially now we're talking maybe for another year to grow the book bigger because, yeah, I mean, you can be profitable with 25 million, to be honest.
Yeah.
But then your profit you're generating is never going to be huge. We're more ambitious than that. We want to get to a much bigger book, basically.
Yeah, we've seen some of the most profitable peer-to-peer companies who are not operating anymore. So it's more important that the company is doing the right thing behind the scenes than showing big profits.
But we always focus on profitability, and that gives us some constraints. For example, the £1,000 you mentioned earlier, right? That's the constraint for us to get to profitability quicker.
Yeah.
And then we can review that.
Okay, so that's why you have to invest £1,000 in each loan, because you want Blend to be profitable so they'll stay around for a long, long time and make you a good return on your money. Stephen Hale, Yann has asked, we have all learned from Lendy, but how do we spot the good from the bad? Briefly, we'll just, we've chatted about that already on the stream about doing due diligence on the people that are running the companies is certainly one place you can start trying to spot from the good from the bad.
Yeah. And exactly, due diligence as much as you can. I mean, it's a difficult thing. You look at Madoff, everyone trusted him, and he was a fraud as well. I mean, some fraud are probably easier to spot than others, but I don't think Lendy was an easy one. I didn't invest on Lendy. I don't know much about what happened, but yeah, it is for sure a risk. So, I mean, I've been regulated by the FCA all my career, which in a way give a bit of a stamp of of quality, not of trust, basically. And we're backed by some really high profile who's done a massive due diligence on us. I mean, all those equity shareholders I mentioned in the beginning, they're the big guys, and trust me, they don't want to be associated with a fraud. More than losing the money, they don't want to have their name associated to anything bad, and they've done a massive due diligence, and that's why I think gives some trust. Having those guys backing us gives some trust to lenders on our platform. I'm sure the platform went bust didn't have guys like that backing them. I'll be surprised. Yeah,
absolutely. Again, we'll just go through these questions very fast, quick, like 1 minute answers. Norman said, how do we know if a valuation is realistic on a development loan? As an investor?
I mean, you gotta rely on the quality of the platform. I think. I mean, you can do what we do. We do uncomparable. You can use Zoopla, Rightmove, so you can see sold prices on this platform, and you can do exactly like we do. So we're gonna challenge it, and you can challenge it the same way. Look, what's the price per square foot, but look the type of assets, if it's detached, semi-detached, how much do they trade, and are you in the right range of prices in the area?
Okay.
So do the same job, really.
Okay. Dave Dawson has said, Blend appears to offer higher rates than one of your competitors, Cufflink. How do you do that since you both offer property loans?
So, difficult to speak for the other. I thought Cufflink was a bit more focused on bridging than development.
They do a lot of bridging.
There's one thing of that. Then the second thing is what spread do they charge? I don't know. It's really show me a loan and I can explain you why easily. I mean, we try to look for good risk reward, but I don't think we're charging 12 when the market is at 8%. You see, I mean, if we charge a rate to the developer, he's always comparing. So I don't know, if someone gives you a lower rate, maybe it's lower risk, or maybe they're charging a bigger spread, and that's why I think transparency is key. So I'd be curious to see what's their all-in price to compare to the all-in price. Maybe I don't know.
Okay.
I really need to see the deals.
Yeah, understood. Mike Powell has said that he can open a account with a bank and some other platforms without a passport or a driver's license as they verify electronically. So why does Blend need those additional things?
I'm confused about this because when you register, you put you upload a copy of your passport, exactly like you're gonna open a bank account.
I don't know. He's saying that he can open other accounts with banks and platforms without a passport or a driver's license as they verify you electronically. So why does Blend need those additional things?
I mean, we do a deep maybe KYC and ML, but I tell you what, as an example, I've opened a bank account with Revolut a while ago without a passport, and then I had notification every day. 2 years later, 3 years recently, like 6 months, not even 3 months ago, saying you need to upload your passport. You need to upload your passport.
So they got you hooked in and then made you.
Exactly. I mean, I don't know, and I know they had toughened a bit their KYC and onboarding relation. Maybe we're a bit more conservative on those risks than money laundering. We're a bit tougher on money laundering than other platform. But as I said before, it shows how we do it, and in a way it's a good thing for investors if we're a bit tougher.
Yeah, absolutely.
But you can do it electronically for sure, and yes, we need a copy of passport, but I would think, what's the issue of giving a copy of your passport if you're going to give your money?
That's really true. So here's a question from Stephen Hale. He said, do you think the Bank of England has a clue what to do? It seems very panic in this rate reduction.
I mean, yes, you had to reduce. I mean, now I think the thing is keep the rates to zero and print. My hope is Bank of England is going to talk with the other central banks and print together, because the only way we can get out of this crisis is two ways: either print or increase taxes. And if we increase taxes, it's going to be for us and the next generation, I think, to pay for all this. So I hope they're going to print all together. Now the risk you have is inflation, longer term.
Yeah.
But not in the short term, and definitely not in the short term.
I think the tax increases are going to come at some point, but that's just my personal view. Martin in Leeds, nice to see you, Martin. He said, today NatWest chairman said UK banks not ready for negative interest rates. Any comment on that? You think negative interest rates are coming to the banks?
It's not impossible. You see it in euros already, so it's not impossible. They want people to spend. It's not impossible. They're not ready, obviously. They're not going to announce it now, but if things gets worse and your rates are zero, what can you do?
That's true.
They're not going to do it if they can afford not to do it. It's not a great thing to have negative rates. But in euros, you already see it, so it's not impossible.
Not impossible.
Hopefully not. I mean, I don't expect it in the short term for sure, but
yeah,
it's not finished. This crisis, I don't think we're finished out of the corona. It's we're gonna see more damage, I think, in some sectors.
Okay. Mike Powell says, do you charge default interest or fees on loans, and does this go to you or to the investors?
Do you charge, sorry, what?
Do you charge default interest or fees on loans?
Yeah, so what happened is, if your loan is in default, we charge default rates, let's say 6%. We share it with the investors and we give it to the investor first. So if we will give 3% if we can recover only 3%, we'll give the 3% to the investors and nothing for us. And if we can get 6%, then we get the second 3%. So we always try to line up the interest. We put ourselves after, so motivates you to recover the money, obviously, for your reputation, your investors, and then you get paid once everyone's paid. So
Okay, that's a good thing.
Yeah.
Tony Walton says, in the worst case scenario, what is the wind down procedure for the platform? I presume it would be pretty standard, having a third party facilitate the continued payments of the loans.
Yeah, so I mean, if I gotta go through it, it's
No,
70
don't
pages,
go.
and
Is
but
it?
we have a living will if we're insolvent. We have our self wind down plan and a living will.
Is that information found on Blend's website?
There's an executive summary of it, but obviously not access to everything because there's a lot of confidential information in the full wind down.
Okay.
Access to our accounts and everything.
Couple of nice comments here. Dave Dawson says, sounds good. I think I will be investing some with Blend soon. And Paul Bagler said, quite impressed with your information he's in. So, and Stephen Hell said that he's really enjoyed your open and honest approach. Tony said, do you have an IFISA?
We don't have the ISA, which actually I had a chat yesterday again about it because it's something we want to do at some point. It looks like it's a great thing tax-wise. It's a great thing. I mean, we accept SIPs and SAS, but not IFISA yet. It looks like the FCA is putting this under review, to be honest. Mm-hmm. So I think we're gonna let it see how it goes, see how it matures. If things goes well with it, I think we should take it. We should do it because it's a great tool. But I heard a lot of different opinions about people investing through the ISA on platforms. So it's not in the plan for now, but I think we're going to review it probably in 12 months' time. Yeah.
Okay.
That's the part.
Okay.
That's the plan.
And I'm going to try to get you out of here soon because I know we've been on for about an hour and 15 minutes. So we'll run through these last couple of questions quickly. Any thoughts on how Corona is going to impact Blend's business? It's not over yet and the cases are exploding.
So obviously a full lockdown where developer can go on site is bad for the platform. We've seen it in April. We have enough cash to literally have 12 months of zero income and pay for the staff. So we're not concerned about insolvency, but we want to do business. I'll tell you what, I mean, my background is trading gold. 2008 was a very good opportunity for me. So I've made a lot of money when there's a crisis. So I see, and I don't think we will be in business as Blend or as any peer-to-peer platform if we did not see the previous crisis of 2008. So I think when you have a change like that as a business, obviously on the health side, hope everyone is going to be okay, and that's the concern. But on the business side, you got to take those as opportunity and try to see through it what's going to happen after. And for us, as I was saying, with some competitors shutting down or putting staff on furlough and did not operate during this crisis, we have managed to win market shares in the market, and we're looking to expand now. So we see an opportunity as a business. Obviously, I mean, be honest, I prefer we get everything gets sorted quickly and we can go out in the evening and everyone's healthy. But yeah, you gotta manage a business even during this crisis. It's difficult, but you gotta see through it and see where the opportunities are. And not sometimes if you have to change to adapt yourself. So for us, the first thing, as I said, we've done was reducing the loan to value, and now we're seeing better quality deals post-corona because we reduce our criteria.
Okay. And Scott Peacock has asked, how many people do you have on the payroll at Blend?
We're 7 now, and we have 2 starting in November, and looking to hire more if we find the right people. It's difficult, actually. I'll be honest with you. It's difficult to find the very good people to share with you. When we focus on the small and medium loans, right? And you tend to see the best quality people doing the underwriting on the bigger loans. So we initially were looking at competition, and we haven't hired anyone from competition because it's difficult to find top guys, so to attract the top guys. So a lot of people we hired either came from the market were doing bigger loans or property developers in the past, which is great because they understand the deal in 2 seconds. Like there's a great communication between developers and them.
Right. Yeah, that makes sense. Okay. I think we're going to wrap it up then. I'm going to put the link in the comments, so if you want to sign up for a Blend Network account, go ahead and do that through that link. Thank you, everybody. Please hit that thumbs up and subscribe. Yann, you've been a gracious guest for answering everything as transparently as you have. I've always enjoyed our conversations over the period of the years. So, any last comments that you want to say to people about Blend?
If anyone wants to register on Blend, feel free. You can see the deals. You don't have obviously to invest. You can just access full information when you're fully registered. And if anyone has a question, I know we're a platform online, but I'd like to call it peer-to-peer, face-to-face. So if you want to come and meet us, maybe now it's difficult, but feel free to give us a call or send us an email if you have any questions. We're here to answer.
Yeah, you're based in London too, right?
Correct.
Yeah, whereabouts in London are you now?
We're on Maddox Street off Regent Street.
Same place.
Same place now. We're moving in January. We need bigger space, so we're moving soon.
Okay, very posh up there in Regent Street. I know. But again, yeah, thank you again. Thanks for everybody for joining us. Don't forget, next week I am off on the holidays, so I'm not going to be here. There will not be a stream until November 5th, and we're going to... Sorry, yeah, did I say that? November 5th. We're going to have another guest. Actually, wait, no, I'm saying that wrong. We have a stream next week. Ignore that. Thursday next, on the 22nd, we have another stream with another guest. And then I'm off on holiday, and we'll be back on November the 5th. So, again, thank you, Yann. Everybody, have a great week. And be safe out there. Don't get coronavirus if you can stop it. And we'll see you next week. Thanks again, Yann.
You guys, bye.
Okay, bye.